Welcome back. You're watching HFO-TV.
Welcome back to HFO-TV. I'm Greg Frick, partner here at HFO Investment Real Estate. And today joining me is Mark Paskill, Vice President at Intervest Mortgage, which is a member of Umpqua Bank.
Thank you.
Thanks for coming.
Thank you.
I think we want to talk a little bit about kind of what's going on in the multifamily side on the finance, the multifamily market in Portland. What's, kind of give me a little, maybe a rundown on where we were last year and what you're seeing going forward this year in terms of rates, activity, refinance versus sales.
We've seen a continued boom of refinancing for sure. Everyone's looking at the rates and saying, oh, the rates are great. What can we do? How much money can we pull out? Rents have moved, so equity has moved on a lot of people. So I would say it's been a very active year. We've seen probably more refis than sales.
And are you looking at, in terms of trends, are we seeing maybe more life companies coming back in, the CMBS market jumping back in? I know we hear that, we've seen that in some of our transactions. Kind of what's your take on it?
Yeah, it depends on the size of the property. We're seeing the kind of the smaller $1 million to $1.5 million properties are being done, mostly bank. Okay. We're seeing CMBS is back, but more transactions where people are having issues or they're going for max leverage. The biggest change has been at the agencies. Fannie, Freddie have changed. Right. They came out with a mandate of doing no more than 30, I think it's $30 billion per agency for this year. That slowed it down. So the agency pricing has widened a little bit with the idea that they don't want to do more than the $30 billion. Got it. So we've seen the agencies kind of shift around, and now Freddie Mac has come out with a small balance program to kind of pick up some of that slack that Freddie can't do.
And who else is coming into that vacuum as they start backing out a little bit? Not that they're completely out.
Well, they're more backing out, or their pricing is widened for the larger transactions. So they're using that 50 units as kind of the break point. So what we're seeing is over the 50 units, you're starting to see the life companies beating the agencies. CMBS is beating the agencies on the real, nicer couple hundred unit buildings as they can.
Class A core stuff.
Exactly.
And on the underwriting side, I know we've, a lot of people are comparing the market as it was kind of before the crash. What's kind of changed in underwriting on the multifamily side? I know there's liquidity questions now, I think have come to the forefront of a lot of our transactions. Mm-hmm. The building has the debt coverage, but the liquidity of the borrower, kind of what's your take on that? Yeah,
we've seen that. The liquidity of the borrower has always been very paramount. We're finding that obviously no one's really worrying about debt service coverage because the rates are 4% and 3.5%, and everything kind of works at that level. But we're seeing more of a concern of management experience. What can they do? What can they not do? That's kind of we've seen more pressure on that.
Right. And then from your standpoint, we didn't see a lot of distress in this market. We've seen a lot of it, some of it had to do with management. Maybe it's, they had another asset. And I mean, is there any concern of, where the market's been, what's going to happen in the next couple of years in terms of rates and how that's going to affect?
What's interesting is we saw that about 2 years ago where people were really concerned, like, okay, we're underwriting a transaction at 4.25% and it's getting done, and what's going to happen in 3 to 4 years. Now it seems like that pressure has kind of really fallen off. Okay. It's not a conversation. People aren't that concerned that, we're talking, okay, the Fed may bump short-term rates. Maybe they don't. They probably won't, is kind of what our take is. The feeling is that there's a long ways to go before short-term rates move. So there hasn't been a lot of that pressure. I think the bigger concern from the lender side is looking at the rents and are they sustainable in the long term? But we've also seen kind of an interesting trend recently, a lot of lower leverage transactions where people are, for whatever reason, they're not max leveraging it out, and that could be a factor of risk tolerance. It could be a factor of we don't know where we're going to put our money. It could be a factor of an aging investor base that's getting more ready to retire, and so they're not trying to leverage it out. But we've seen more transactions under, call it 50% in the last 4 or 5 months than we probably have ever seen.
Really?
On the smaller $5 million under space.
Right. Now we've seen that too. Now it's the same question we have. Is it because of risk tolerance? Is it uncertainty of what's going to happen in the future? So I'll lower my exposure. That's been an interesting, because again, real estate's always been leverage as king. Especially in the multifamily market because of the perceived safeness of the investment. Now we've got people saying, hey, I don't want to go above 50%. It's going to protect me on the downside. So
But it's interesting because the new Freddie Mac program, which is on the agency side probably one of the most competitive programs today they say it's $1 million to $5 million, but it's really limited up to 50 units, so they can go up back, I think it's $7.5 million is the real cap. It's kind of where they kind of balance out. But they can do up to 80% LTV, declining balance prepay. So we've been doing a bunch of those transactions at our office, and it's really attractive.
And are they able to do that on a refi too, or is it just more of on a purchase?
On both.
On both?
On both.
Okay.
Yep. Yeah, so the tolerance for cash out is very high. It's a really kind of neat program.
And what about repositions? Acquisition, rehab, or reposition plays?
Most of those have been around interior unit renovations, it seems like. Getting the rents, buy a complex, gut it, or do a partial gut or a rolling gut, depending on.
Right.
We've seen that. We've seen people doing it out of cash. We've seen people looking for some bridge loans, some construction loans.
Okay.
But we've seen less traditional construction lending for that and more cash.
So it's more cash coming in, just some kind of holdback or something like that. Yeah. And I know you probably get asked this all the time, as we get asked as well. What is the recommendation moving forward in terms of interest rates? It's, we've been saying for 10 years, geez, rates at some point are going to go up. We're going to get back to the median. Do you do a 5-year, 7-year? What are you seeing? People still sticking in the 5-7? Is it?
We see it it's almost generational age. Like you look at a general person, if they're 20 years old or 30 years old and they're buying an asset, they're not really thinking that this is a retirement asset. They're thinking it's a retirement capital base that they're going to move through different assets.
Right.
And so they're going to generally go a 5 and a 7 or maybe even a 3-year. We're seeing people that have maybe been in the industry longer, or they're older, or they're getting closer to a transition or retirement. They're going for a longer term fixed. But we are seeing in the $5 million and under, almost all that borrowing size, that loan size, people are doing something with a flexible prepay because they're thinking something's going to happen. Over that asset, then we're seeing more, hey, I really want 10-year money, or I want 15-year money. And that's where we do a lot of work with life insurance companies.
For that space.
Yeah.
Are they getting creative on their prepays? We start going.
We haven't seen that. There's a lot of money in the market.
I know.
In both debt and equity. But the amount of equity, or a lot of debt that wants in the market is just phenomenal. So we're seeing life companies are very active, banks are really active, agencies, even though they've got a cap, they're still being very active in the space. The agencies make about 30% of the overall financing market. Okay. If you look at in whole, but some of the life companies are burning through their allocation. So a life company lender has maybe $1.5 billion allocation to spend for the year. Sometimes that's a fluid number, sometimes it's a hard number, but a lot of them have been burning through them this year. And some of them see that as a positive because that means next year they can have more allocation. Some are more concerned about, well, since I'm burning through my allocation, maybe I'll move my rates, because they want to capture the last part of the yield curve in the second half of the calendar year. Yeah. So it's an interesting dynamic to see a portfolio lender, how they manage and disperse their funds. Yeah, with quarter by quarter, month by month. Exactly. And what about tertiary markets? Are we seeing more or less with the tightness and demand and limited, is it Salem's now on the map? I know they're on the map, but from a lending side, is that an easier sale now, or is it still, they want to be within the? What's interesting is it's not necessarily a harder sale in terms of where the price per unit is or the cash flow is. It's more of which lender will go into it. And so you almost have to shift your hand and say, okay, well, we've got a transaction, and say a guy's buying a building that's off the I-5 corridor. There's certain lenders we work with will not go to those markets. National banks won't go to them. Our parent company gets a little less interested in a transaction if it's far off the I-5 corridor or in a smaller market. We've got credit unions, we've got life insurance companies, ironically, that will follow the right borrowers into some of those markets. Okay. Some of the regional, community banks will go into those markets as well. But it's not a slam dunk. Well, of course, our financing structure is going to be XYZ because the property is in, outside Eugene and Veneta or something. Right. Okay. Offensive Veneta. And this is just kind of we were hearing a lot of talk within Portland on unreinforced. Have you heard any talk on the lender side on how they're going to look at that? Because on our side, on the investment side, the question now is, if I'm looking at an unreinforced or there's a potential of having to do seismic upgrades, how do I price that in, either buying or selling at this point? If nothing's concrete, but it looks like there's going to be something coming down. Are the lenders? Have you had any conversation? Is that even on the map yet? We've seen a lot of the unreinforced transactions. Right. and we've done our fair share, and
Yes.
a lot of lenders have done their fair share. The question becomes of how do you quote a loan when you don't know the whole transaction on reinforced?
Right.
So generally what we're seeing is it's going to be a lower leverage or a very sophisticated borrower where the thought process is in an earthquake, do they have the financial wherewithal to step up?
Okay.
Or trying to keep your loan so low that you can, your insurance proceeds are clearly going to take you out. But there's definitely some lenders that will not touch them.
Right.
Or they're going to say, well, I'm not going to do more than, say, 60% or something.
So it'd be an LTV adjustment to offset the risk.
Generally.
Yeah.
Yep.
Yeah,
And then a lot of the unreinforced masonry are going to be in a urban core. You're going to have really high land value. So we've actually done a couple transactions where the land value, we were like 110% of land values. So really your exposure to the building is really minimal.
Right, you've got the land security.
Yeah, you get the land security.
Right. Yeah, it's a question we've had just in terms of underwriting and projecting out, who's making the adjustment. Nothing's been official, the buyer, know it's coming, so, do we just arbitrarily put a number on there to try to cover it? But it's been an interesting deal.
Well, we've seen some lenders that are less sophisticated in the multifamily space, and they will lend on unreinforced masonry because they don't do a lot of multifamily. They don't see the perceived risk, or they're more comfortable with the borrower's strength.
Right.
And so we're doing a 60% loan, and we like the borrower.
And with rates this low, are we looking at more, 15, 20-year non-traditional? Traditionally multifamily, it's 25, 30-year AMs. Are you doing any 15, 20-year fully AM where we, can still get some positive debt coverage because the rates are so low, and somebody's really thinking as a long-term, it's going to sit in a family for 15 years. I just want to.
Yeah, definitely. Yeah, definitely. We've been doing, and that's all traditionally going to be life company. Some of the national banks have their 15-year AM, 15-year amortization or term. The banks tend to be it's more of a secondary product, where for life companies it's more of main product for them, so they can typically beat it in rate and structure.
And what are the new hot points in terms of underwriting, maybe that's different for the audience that doesn't know, things that are kind of maybe weren't on the radar or on the radar or getting more scrutiny from an underwriting standpoint as we're moving through the cycle? Is it, reserves need to be higher, making tax? We've had on new construction, it's been property taxes. Are we allocating a right number for property taxes? How are you guys dealing with that as we go along?
For underwriting, I'd say maybe it's different this year than last year. In a ironic, with the way the market's going, maybe it's even a little less intense.
Really? Okay.
Because there's so much money that wants to get out. I wouldn't say it's less in terms of what the main points they're looking for, not getting looser, but more confident in what they've collected.
Got it.
If that makes sense.
Yeah.
So we're not seeing on your tax return there's this item, and what in the heck is this, and how did that happen? It's more of, okay, that happened 3 years ago, and not beat it up.
Not today, okay.
Not that.
And then what about, and do you have any, from a lender's perspective, all the new construction we have in Portland? Portland's on the map, we're the place to be in the West Coast. Is there any rumblings, with life companies and the agencies of, when is this party going to slow down? Or can we continue this kind of rent growth? Are you hearing any whispers? That's kind of, when lenders start talking about it, and that may change the financing options. Have you heard anything like that in terms of Portland?
I think the lenders have been concerned about the new construction for the last 36 months.
Right.
But I think the market has been showing that it's going on, but it hasn't affected it yet.
Yeah.
And so I think after a while, everyone kind of gets used to that concern, and the concern kind of goes away a little bit.
Yeah.
But obviously the concern is there. We see it on the portfolio lenders. The life companies are more aware of it in terms of when they're going to their credit committees than maybe the banking side, because the banks are looking at the appraisal, they're talking to people, and they don't see it out there, where the life companies know that this is going to sit on their balance sheet because the yield maintenance for a longer period of time. So
they may be sitting with it for 10 years, 15 years.
Yeah, where a bank transaction is going to have a declining balance prepay, easier to pay off. By nature, it rolls more.
Okay.
So you don't see that concern as much. The agencies are definitely more concerned.
Okay, yeah, from our standpoint, that's been the big question. Can we continue this rent growth? Yeah. Looking at wage growth, how do we do that? And construction lending is interesting because we see a lot of construction requests.
and the construction requests will change based on lender demand as an aggregate in the market. So if we start getting a slew of construction loan requests in a shorter period of time, being called a month, 3
Right.
weeks, you can tell that means, or a month and a half, you can tell that other lenders are now either full or concerned internally on their existing book, and so they're saying no, and so the borrowers are maybe
Having to go other directions.
Correct.
Are you seeing that now? Have you seen that in the last quarter?
Yes.
You have?
Yes.
Yeah.
Yeah.
Yeah, no, because we've been asked from the development side, maybe what are some other options in terms of lending? And it's like you said, it almost feels as if some of these traditional new construction, they've kind of hit their allocation, or there's, hey, we've got enough, exposure in this market. Let's either dial it back a little bit, or
We've also seen through this cycle the traditional commercial players, office, industrial, retail developers move into the multifamily side, do some merchant building. We've seen probably more of them not taking on new projects today than they were a couple of years ago.
Okay.
Which is kind of an interesting.
Right.
That could just be where the available land. It could be where the inventory. They came in, they did their projects, and they would do 5 more if they could, but they can't because they can't find the land.
Right, we're not finding any more easy projects to do, so
Yeah.
no, definitely. Well, thanks for coming in. If you guys have any
thank
information
you.
for Mark, you can see his phone number and website down below. And we'll see you next time on HFO TV. Thank you.
Yep, thanks for having me.
It was great, thanks.
Yeah.
Good.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.